PantheonAI presents Shell plus BP mega merger, Powell's rate pause, and Tesla Robotaxi drama. Welcome to the PAI Morning Briefing. I'm John, and I'm really glad you could join us today, June 25th, 2025.
And I'm Sarah. Good morning, everyone. We've got a packed show for you, diving deep into the latest market trends, breaking news, and the kind of insightful analysis you depend on to navigate today's financial landscape. John, where are we starting?
Let's jump right into it, Sarah, with a quick look at the major market indexes and some of our cryptocurrency movers. The S&P 500 is trading around 6,094.0698. We've seen a very slight dip, about negative 0.166%, which, tells us there's a little bit of nervousness in the market this morning.
Right, a subtle shiver. And what about the Dow and Nasdaq?
The Dow Jones has declined by roughly negative 0.2746%, trading at around 43,011.84. And the Nasdaq is down by about negative 0.248999%, resting near 19,964.08.
So across the board, a bit of a cautious start. And the Russell 2000, usually a good barometer for smaller caps?
Even more so, actually. The Russell 2000 is showing a slightly larger decline, down nearly negative 0.93473% at roughly 2,142.79.
Definitely a theme of hesitancy there. But, John, I heard there's a bit of a bright spot in the crypto space?
You're right. Amidst the broader market's mixed performance, Bitcoin is actually showing an uptick. It's trading at about 107,170.53, up by roughly 1%. But here's the interesting part. Ethereum isn't quite sharing that enthusiasm, as it's down by nearly negative 1.6947% at around 2,408.18.
That's a classic reminder, isn't it? While traditional markets might show mild caution, crypto still brings that wild volatility and, for some, plenty of opportunity. It's never boring.
Never. Now, stepping away from these headline figures, let's delve a little deeper into what's been driving these broader trends. When we look at the slight declines in traditional indexes today, it really suggests that investors remain a bit cautious. There's a hint of hesitancy as market participants digest an evolving array of developments.
And that quote, evolving array really boils down to uncertainty, doesn't it? I mean, we've got geopolitical risks, shifting narratives on fiscal policy. It's a lot to take in.
Exactly. Uncertainty about monetary policy decisions, especially with Fed Chair Jerome Powell's ongoing testimony. Uncertainty in the energy sector with whispers of a mega merger between Shell and BP. And even shifts in valuation narratives, like the fading Buffett Premium from Berkshire Hathaway's stock price.
Oh, that Shell and BP rumor has really got the market buzzing. Tell us more about that, John.
It's one of today's lead stories, coming out of the UK. Shell, one of the world's largest energy companies, is in early-stage talks to acquire BP. If this comes to fruition, it would be one of the largest deals in recent memory. The idea of combining these two titans has investors talking about the implications for global energy dynamics and market consolidation.
I can only imagine the synergy, or let's be honest, the headaches, of blending two massive operations that have historically been competitive. It makes you wonder, could this be a signal for the industry to really shift gears in a rapidly changing energy landscape? Or is it a wake-up call for regulators worried about too much concentration?
Both, I think. And while energy executives are mulling over gigantic mergers, the financial policy realm is buzzing too. Fed Chair Jerome Powell took the stand today before the Senate banking panel.
His remarks were pretty measured, right? He emphasized that the Federal Reserve is well-positioned to wait on any immediate changes to interest rate policy. It gives us a real window into their approach. They're not rushing to adjust rates until they see a solid footing in economic indicators.
That cautious stance, echoed by market participants, might partially explain the slight declines we're seeing in the traditional indexes as traders await further signals. It's all connected.
Absolutely. Now, shifting our focus to one of the more intriguing narratives out there, the so-called Buffett Premium. For years, investors were convinced that buying a share of Berkshire Hathaway meant paying for a piece of Warren Buffett's legendary foresight. But it seems times are changing.
Yeah, the aura surrounding Buffett's investments seems to be losing its luster. An interesting article highlights how that once reliable extra valuation, this premium is slowly fading into history. It's a fascinating interplay between reputation and performance, isn't it? Are investors still buying into the myth of the Oracle of Omaha, or are they starting to dig deeper into fundamentals?
I think it speaks to a broader trend. As we see more investors questing for tangible, transparent value in a world increasingly distorted by speculation and hype, the market is reevaluating what price they're willing to pay for that intangible aura.
Good point. And speaking of hype, another story garnering attention today revolves around Tesla and its much-discussed Robotaxi. Tesla's recent event showcased its ambitions in the autonomous vehicle space, generating an infectious sense of excitement. However, early indications from the company's delivery numbers were somewhat downbeat.
So it's the classic debate. Will the future promise of the Robotaxi fleet absorb the shock of disappointing short-term numbers? It's long-term vision versus short-term execution. And that's where the humor of the market sometimes comes in, right? Like, are we investing in a futuristic spaceship on wheels? Or just putting a state-of-the-art computer in a car that still has to navigate a traffic jam?
Exactly. It's a good question. Let's put on our magnifying glasses now and walk through a few more of today's significant stories that might have some ripple effects on various sectors.
All right. First up, a rather serious piece of news about new home sales. In a notable development for the housing market, we've seen new home sales plunge to a 7-month low. Buyers are really shying away, deterred by high prices that feel almost as challenging as running a marathon in quicksand.
Despite builders tossing discounts and deals like confetti, the market appears cautious, hinting at a potential further weakening. Are we looking at the beginning of a cooling cycle in residential construction, or could this just be temporary as the market adjusts to newer realities in mortgage interest rates and affordability?
That's the million-dollar question. On the policy front, there's some buzz about a massive tax bill that has Republicans getting a bit cold feet. The White House is touting that it will catalyze growth by more than 1 percentage point annually, but as always in Washington, the devil's in the details.
The prospect of higher taxes for various segments of the economy and the heated debate that comes with any significant tax proposal could have far-reaching ramifications. We might be on the verge of a major fiscal restructuring, so it's worth paying close attention to how this evolves and what it means for your portfolio.
Definitely. Now, a related piece that offers a strategic takeaway for investors in the midst of uncertainty. Goldman Sachs recently declared that, quote, the era of diversification has begun, with strategists urging investors to, quote, diversify to amplify.
Essentially, it's a call for spreading risk across various asset classes and geographies, a crucial reminder that in our increasingly interconnected and unpredictable world, putting all your eggs in one basket might just leave you with a scrambled mess. And honestly, who wants to deal with scrambled eggs when you can have a nice, balanced portfolio?
Exactly! And speaking of shakeups, we have a story with a bit of dramatic flair coming out of New York. A recent victory by a prominent figure, Mamdani, could spell trouble for some investors in New York City real estate stocks. Concerns about higher taxes, new regulations, and an intensifying focus on wealthier segments are causing some of these REITs to experience a bit of a shakeup.
For investors with significant exposure in this niche, it might be time for a serious reassessment or at least a conversation with your trusted advisor about potential hedges or alternative investments. In an ever-volatile market, it's always important to keep track of who's leading and who's lagging.
True. A detailed recap of the top 3 gainers and laggards over the past month has emerged amidst a backdrop of tariff worries and political uncertainty in the Middle East. It's quite remarkable how, despite global headwinds, the S&P 500 managed to notch up an advance of over 4% since the last quarterly review of our top members.
That's a reflection of market resilience and perhaps a sign of underlying strengths in several sectors that continue to adapt and even thrive in challenging times. Switching gears to the industrial side of things, McDonald Electrical Corporation recently announced its acquisition of A&J Electric.
This move is designed to expand the company's regional footprint and service capabilities in both electrical and telecommunications sectors across Rhode Island. It's a classic case of growth through strategic expansion, and it comes at a time when many companies are looking to consolidate presence in key regions.
While this might not make headlines on every financial news channel, for those tracking industry-specific developments, it's a noteworthy move that could have local as well as broader sector implications. Now that we've taken a whirlwind tour through the headlines, let's step back and consider what all of this means for various sectors.
Starting with technology. That slow fade of the Buffett Premium and investor skepticism towards short-term performance metrics are indicative of a broader shift. Today's tech investing landscape is as much about the narrative, the brand, and the promise of innovation as it is about clean financials. Tesla's contentious but captivating vision for the future of mobility, particularly its Robotaxi initiative, underscores the need for a balanced view.
Where long-term innovation is weighed against the immediate metrics that drive quarterly reports, it's a tricky balance. And let's be honest, Sarah, if your car can eventually chauffeur you around without you needing to find parking or solve complicated navigation puzzles in a city grid, that's the kind of innovation that makes one smile and sometimes even chuckle at how far we've come.
Exactly. It's pretty amazing. Shifting over to energy, if that potential merger between Shell and BP materializes, we could be looking at a seismic shift in the way global energy markets operate. This isn't just about two companies joining forces. It's about an entire industry realigning itself in the face of climate change, regulatory pressures, and shifting consumer preferences.
The merger would likely create a behemoth with improved bargaining power and increased investments in renewable energy innovations. However, consolidation at this scale always comes with regulatory hurdles and potential antitrust scrutiny. Investors in energy stocks may need to keep a close eye on policy changes and market consolidation dynamics over the coming months.
Definitely. Finance as a sector is being freshly recast in real time, with the Fed choosing caution and central bankers hinting at deferred interest rate changes. The traditional safety net of fixed income investing might soon shift as market players reevaluate their risk profiles.
On top of that, the ongoing debates over tax reform and fiscal policy changes are causing ripples that may alter the landscape for banks, financial services, and even tech-driven fintech firms. Diversification, as Goldman Sachs pointed out, isn't just a mantra. It's becoming a necessity. That means investors need to be comfortable with holding a balanced portfolio that spans across conventional stocks, emerging market exposure, and even alternative investments like cryptocurrencies.
Speaking of cryptocurrencies, let's revisit that dynamic space. Bitcoin's recent uptick, even if modest at around 1%, serves as a reminder that digital assets continue to have their own pulse. Ethereum, however, faced a decline hovering around negative 1.69%, which raises interesting questions about market sentiment within the digital currency ecosystem.
Is this merely a short-term fluctuation owing to regulatory chatter or macroeconomic pressures? Or does it signal a more profound revaluation of digital asset fundamentals? Only time will tell, but for investors engaged in this space, the current volatility may just be an invitation to dive deeper into technical analysis and on-chain metrics.
And on a global scale, these trends are not isolated. The interplay between geopolitical pressures, trade policies, and global economic shifts inevitably affect markets far beyond domestic borders. For instance, while we're digesting news about mergers and tax bills at home, overseas markets are bracing for similar consolidation and fiscal challenges.
It's truly a world where diversification isn't just an investment strategy. It's a survival tactic. Let's talk about some expert insights and predictions that are floating around today, Sarah.
Many market analysts believe we're in the middle of a recalibration phase. Global investors are seemingly rebalancing their portfolios to hedge against both inflationary and deflationary pressures. There's a growing consensus that while equities might see some corrections in the short term, sectors like technology and renewable energy are poised for a more robust recovery in the medium to long term.
The potential merger in the energy sector, combined with a cautious stance from central banks, might really create an environment that rewards long-term strategic positions over short-term speculation. If you're an investor asking yourself, where do I steer my ship amid this storm of shifting trends? Well, one thought-provoking notion is to keep a steady hand on your diversified portfolio and remain agile enough to seize opportunities when they arise.
We've seen time and again that markets are cyclical. Today's minor downturns often pave the way for tomorrow's breakthroughs, especially when viewed in the context of global trends and technological advancements. And let's tie this together with a detailed sector analysis focusing on technology, energy, and finance, starting with tech.
The tech sector continues to be a dominant force in shaping market narratives. With the current climate of declining valuations that were once inflated by the quote premium and an increasing emphasis on tangible metrics, companies with robust fundamentals and compelling innovation are likely to stand out.
Consider Tesla's Robotaxi project. While delivery numbers might be slightly underwhelming in the short term, the underlying technological promise and a bold push towards autonomy could well be a harbinger of disruptive market shifts in transportation and mobility. And let's be honest, If your car can eventually chauffeur you around without you needing to find parking or solve complicated navigation puzzles in a city grid, that's the kind of innovation that makes one smile and sometimes even chuckle.
Absolutely. Shifting over to energy, if that potential merger between Shell and BP materializes, we could be looking at a seismic shift in the way global energy markets operate. This isn't just about two companies joining forces. It's about an entire industry realigning itself in the face of climate change, regulatory pressures, and shifting consumer preferences.
The merger would likely create a behemoth with improved bargaining power and increased investments in renewable energy innovations. However, consolidation at this scale always comes with regulatory hurdles and potential antitrust scrutiny. Investors in energy stocks may need to keep a close eye on policy changes and market consolidation dynamics over the coming months.
On the financial front, the cautious tone from the Federal Reserve, as recently echoed by Fed Chair Powell, suggests that banks and financial institutions will continue operating under a cloud of cautious optimism. While this may temporarily signal lower short-term profitability in some sectors, the long-term benefits of a maintained equilibrium in interest rate policy could lead to more stable growth.
Additionally, debates over tax reform present both challenges and opportunities. For example, as Republicans express reservations about a massive tax bill despite its promised economic boost, financial firms might need to brace for a phase of readjustment and volatility, particularly if the tax bill is implemented unevenly across different income brackets and industries.
Taking a step back to the global implications, what does all this mean for the international market? Investors should be mindful that while today's headline news revolves largely around domestic and Western-centric events, the ripple effects of these changes are likely to be felt worldwide.
For instance, energy consolidation in Europe can prompt shifts in global oil supplies, which in turn can affect emerging markets dependent on imported fuel. Similarly, shifts in U.S. fiscal and monetary policies often serve as a bellwether for global economic stability. It's a mosaic of intertwined factors that requires a keen, analytical approach.
Yeah, even seemingly disparate events like the cautious Fed stance, tax restructuring debates, and the evolving narrative around the Buffett Premium are all connected. Now, let's bring in some expert insights that might help guide your long-term thinking. Many seasoned analysts suggest that the market is in a transitional phase, one that demands careful risk management and a diversified approach.
It's not enough to chase the latest trends. You must understand the underlying fundamentals driving each sector. Whether it's the tech sector's drive for innovative disruption, the energy sector's balancing act between fossil fuels and renewable initiatives, or the financial sector's navigation of policy and regulatory landscapes, every segment of the market tells a story. And sometimes, those stories come sprinkled with a bit of humor, like the idea that maybe even the most cautious Fed official might one day start quoting motivational speakers when describing market resilience.
That's a great image. As we steer our conversation toward conclusions and some final thoughts, I encourage you to take away a few key insights from today's briefing. First, while we saw minor dips in major indexes, such as the S&P 500, Dow Jones, Nasdaq, and Russell 2000, these fluctuations are part of the natural ebb and flow of markets that reflect a blend of caution and opportunity.
Second, the cryptocurrency market, represented by Bitcoin's modest gains and Ethereum's slight decline, remains a critical area for investors who are ready to navigate its inherent volatility. Third, from global megadeals in the energy sector to the shrinking myth of the quote, premium, and from central bank caution to tax reform debates, the current market environment is rich with transformative narratives.
For those of you asking, what does this mean for my portfolio? The answer is both simple and complex. On one hand, maintaining a diversified portfolio can shield you from short-term turbulence. On the other, keeping an eye on innovation, fundamental strength, and global trends can help you ride the next upswing.
The markets remind us in often humorous ways that while change is the only constant, sometimes the best strategy is to have a good cup of coffee and a steady thought process, even as a potential mega merger or a policy shakeup unfolds before our very eyes.
Before we wrap up today's episode, let me pose a few thought-provoking questions for you, our engaged listeners. Are you prepared for the potential market shakeup that a merger between energy giants might cause? How will a return to cautious monetary policy affect your investment strategy going forward?
And most importantly, in a world where even the Buffett Premium is losing its shine, what new narratives do you find most compelling in your quest for growth and value? We're always curious to hear your thoughts.
And remember, you can always reach out to our AI co-pilot at PantheonAI if you want to dive deeper into any of these topics. After all, learning shouldn't feel like a full-time job, right?
Exactly. So as we sign off today, here are the key takeaways. Keep a close watch on market news and index fluctuations. Stay informed about the shifts in sectors such as technology, energy, and finance. And approach global events with a sense of pragmatic optimism.
Our briefing today reminds us that every piece of news, whether it's about a monumental merger, a policy statement from the Fed, or even a subtle change in market sentiment within the crypto space, adds a layer of complexity to the investment landscape. Embrace these complexities, stay engaged, and let that analytical curiosity guide your decision-making.
Thank you for joining us on this deep dive into today's financial news and market trends. We hope you found our conversation insightful, engaging, and maybe even a little bit humorous along the way.
Remember, Pantheon AI is here as your trusted information co-pilot, ready to help you navigate these unpredictable but exciting markets. We look forward to sharing more analysis and insights with you in tomorrow's episode.
Until then, keep your portfolios diversified, your minds curious, and don't hesitate to explore new avenues for growth and understanding. And as we wrap up, always remember, learning shouldn't feel like a full-time job.
Have a great day ahead, everyone.
And we'll see you tomorrow. Pantheon AI, your information co-pilot.
Because learning shouldn't feel like a full-time job. Take care and see you next time.